Yes, sir. It was a very nice experience.
Mr. Rudra, let me invite you whenever you visit Bangalore. Kindly do visit our college, sir.
Thank you very
great
much.
honor.
Definitely. Thank you. Look forward.
Yes, sir. Thank you.
It's 8 o'clock. Shall we start now or should we wait, sir?
Mr. Ajayan.
Yeah.
We have the pleasure of having with us Madam Bharati.
Okay.
Bharati, retired MD, CEO of Corporation Bank.
Okay. Welcome, madam. Welcome.
Yeah. Kindly welcome, madam.
Welcome, madam. Bharati, madam. Nice.
Yeah. In fact, yesterday I sent the invite to her, madam. You should listen to madam. In fact, we'll have one of the sessions handled by madam also.
Definitely, definitely. Shall we start at 8 o'clock slowly so that
we'll start, sir. Let others join as the things happen.
Okay, okay. Bharati ma'am.
Good evening, sir. Good evening.
Good evening.
Thank
Welcome
you.
to this session. Nice to have you with us today.
Thank you, sir. It's my pleasure. I was happy to receive the invite from Rao, sir. So I thought, and I've heard Kannan, sir, on many occasions also. So it would really be a very interesting session we are looking forward to.
Madam, one of these, every month, we conduct these kinds of webinar sessions. And one of these months, we'll have your session as well, madam.
Okay. No, I just saw webinar 2. So I thought, how did I miss webinar 1? So I thought,
I forgot,
see
madam.
it on YouTube and get back to you.
Yeah, I did not send it to you. I was very sorry. In fact,
no
after
problem.
that, I realized my mistake. And then
no, not at all. No, it was a pleasure. So I was looking forward to it. So it's a good thing, actually. Many people will have an opportunity to share their views and listen to new things, you know.
Yes, madam. Yes. Thank you.
Thank you, sir.
Princy, can we slowly start?
Yes, start, sir. Again, kindly
start. Princy. Yeah.
Yes, sir.
Princy.
Yes, sir. Good evening, everybody. A very warm welcome to Banking Matters Webinar 2. We welcome you all to the second lecture of the webinar series, jointly hosted by VRDDHI CTS and Southern India Bank's Staff Training College. We were indeed delighted at the mighty responses we received for our first webinar in this series, and this has prompted us to work towards organizing this webinar for live viewership on YouTube. May I now invite Mr. Ajayan K. Anath, Managing Partner with the CTS, to give the welcome address. Ajayan, sir.
Thank you, Princy. Thank you very much. Good evening, friends. Welcome you all once again to the second webinar of the series, Banking Matters. Today, as you all know, our thrust area and the topic is global economic environment and its implications for India. We hope to take this webinar series to the national level and make it the most sought by banking professionals across the country. I feel privileged to have among us Mr. V. Kannan, former CMT of Vijaya Bank, as our chief guest. Welcome to you, sir. Kannan, sir.
Thank you, sir. Thank you.
I also welcome a good friend of mine, Prof. Rudra Sensarma of IIM Kozhikode. Welcome to you, Professor. Both the speakers of the day have been doing brilliantly well in their respective fields. Let me also welcome one among us who has been instrumental in launching this exciting webinar series. Welcome, Mr. KLSN Rao, Principal, Southern India Bank Staff Training College.
Thank you, sir. Thank you.
Thank you very much. This is going to be a great initiative, which is going to mature and grow into big size. A cordial welcome to all senior executives from various banks who have joined today. Executives from RBI, professionals from the industry, faculty, and fellow bankers. We are looking forward to a very engaging and inspiring sessions. Welcome to you all. Thank you very much.
Thank you, sir. May I now invite Rao, sir, Principal, SIBSTC, to present the theme for today's webinar.
Yeah, good evening to all of you. Welcome you all for the today's webinar session. I am Rao, Principal of Southern India Bank Staff Training College. This college was established by Reserve Bank of India in 1972. Since then, we are engaging in providing training to the bankers. In fact, our college is managed by a governing board, and the present chairman of our college governing board is Sri Mahabaleshwara MS, MD and CEO of Karnataka Bank. In one of our governing board meetings, it was advised to us that apart from conducting the training program, why not we have a series of webinars on contemporary banking, finance, and economy related topics. So as a result of this, immediately I contacted one of the most active person in this area, Sri Ajayan of Rudra Consulting, and he immediately accepted. And therefore, today we are hosting the second webinar. The first one was a very great success, which we conducted on the bad bank concept and as also IBC 2016. Friends, we are operating, as all of us we are aware, we are operating in a globalized environment with contagion effect, which means what happens elsewhere may have either a direct or an indirect impact on Indian economy. To talk about this global economic environment and its implications for India, we have with us Professor Rudra Sensarma, Professor of Economics, IIM Kozhikode. Now, friends, you are all aware presently what is happening in US where inflation is seemingly very high, as also in UK, plus there is a prospect of a sort of recession in these countries. So what the impact it will have on in India. So therefore, to discuss on all these things, we have with us Professor Rudra Sensarma, and I will not stand between you and Mr. Sharma to give his thought on the topic. And again, I assure you, going forward, there will be many more exciting topics on contemporary banking, economy, and finance topics, which will be handled by eminent speakers, could be retired CFDs of banks, as also economists and industry specialists, so that the necessary information is provided to the friends across the areas. So thank you very much joining. Thanks the speakers. Thanks specifically to Sri Kannan sir, as also Mr. Rudra Sensarma, and our grateful thanks to Sri Ajayan of Rudra. Thank you very much. Thank you. Good luck and best wishes to all. Thank you.
Thank you, sir. May I now call upon Dr. Mrs. Lalita Menon to introduce the speakers. Lalita ma'am.
You're on mute. You're on mute.
Okay. Good evening. Am I audible now?
Yes, ma'am.
The webinar series Banking Matters is all set to launch the second lecture of on global economic environment and its implications for India. We have two very eminent speakers, Mr. Kannan, V. Kannan, our chief guest, and Professor Rudra Sensarma, the keynote speaker. I take immense pleasure in introducing them to you because they have a very dazzling curriculum vitae. Our chief guest, Mr. Kannan, is the former CMD of Vijaya Bank and is currently independent director on the board of Maximus Reconstruction Company Limited, as well as member of the Settlement Advisory Committee of Canara Bank. Mr. Kannan has held senior positions such as Executive Director of Oriental Bank of Commerce. Since his entry into the banking field in 1978, his track record has been amazing. As General Manager of the Bank of Maharashtra, heading very vital verticals. He has also held significant positions as Director on the board of SBI Factors, on the board of Canara, HSBC, Oriental Bank of Commerce Insurance Company Limited. He has also served as alternate chairman, IBA, member, FEDI, besides numerous high-profile posts. His areas of specialization include investment and treasury management, corporate lending operations, international trade, finance, and dealing room operations, besides much more. Mr. Kannan has attended several seminars and training programs in the US, in the UK, and Japan. Welcome once again to Mr. Kannan. Our keynote speaker is Professor Rudra Sensarma. He is a distinguished academic, currently Professor of Economics at Indian Institute of Management, Kozhikode. He has 2 decades of experience spanning RBI, IIM Lucknow, University of Birmingham, and the University of Hertfordshire. After his master's from ISI Kolkata, Mr. Rudra Sensarma went on to do his PhD at IGIDR Mumbai and postdoc fellowship from the University of Birmingham. His areas of interest are macroeconomics, financial markets, and development finance. He has published extensively and has conducted research projects for agencies like Ministry of Commerce and Industry, NITC Ayog, and NABARD, NITI Ayog and NABARD, excuse me. He is a fellow of the Higher Education Academy of the UK and an external associate of the Center for Crime, Justice and Policing at the University of Birmingham. He is also a member of the Expert Committee of Technology and Innovation for Monitoring and Evaluation, TIME, Lab of Niti Ayog. So that is a very impressive brief of our splendid speakers of the day. Thank you.
Thank you, ma'am. May I now request our chief guest, Mr. V. Kannan, former CMD, Vijaya Bank, to address the participants. Kannan, sir.
Thank you. Thank you, ma'am. First of all, my sincere thanks to Ajayan, Mr. Rao, and Professor Sharma, and greetings to all the participants who have taken time to participate in this program. Today we shall be looking at global economic environment and its implication for India, right? The first question that comes to the mind of many people is, why are we talking about global environment when we have more than adequate problems to address domestically? Yes, you're right. While the pure play domestic factors like the success or failure of the monsoon, inflation, liquidity, an inclusive and job-oriented growth, COVID-19 containment and its impact, all domestic factors will definitely be the focus of the regulator and the government, for which more than adequate measures are being taken. Yes. But can we ignore or can we totally insulate ourselves from what is happening around the world or in other economies? The answer is a definite no. Having opened up our borders for trade, liberalized free flow of funds across borders, and having many free trade agreements, we are not and cannot remain insulated from what is happening around the world in other countries, particularly so with our major trading partners. But what is the global economic conditions today? They have turned unfavorable for growth from the combined shocks. Number one, the Russia-Ukraine war, the COVID-19, the continuing threat. Yes, we have seen wave 1, 2, and 3, and still we have not seen the end of the tunnel. The tightening of the monetary policies to rein in inflation in many countries. This has generated apprehensions of a recession in major economies. In fact, the recent IMF report of July 2022 describes the situation as gloomy and more uncertain. What else we can say? And has lowered the global growth forecast for 2022 with significant downgrade for advanced economies. But the silver lining is they are positive on India, which they say will grow at 7.4% for 22-23. That's the highest among major economies. Now, post the outbreak of the Russia-Ukraine conflict, increasing uncertainty amongst investors has led to capital outflows, not just from India, but also from the group of emerging markets. This has resulted in the currencies of several countries depreciating against the US dollar, including that of India, adding to the inflationary pressure. In fact, if you look at the figures, between January to July, foreign portfolio investors have pulled out $48 billion from emerging markets as a whole. Now, there is an increasing trend of interest in the US, and the perception of the inverse to seek safe haven investments in times of distress has again resulted in outflow of US dollars, not only from the Indian market, from everywhere. In the Indian market, till June, we have seen heavy outflow, which seems to have corrected itself from July. Apart from all these things, the following questions still remain. How long the Russia-Ukraine war will last? With sanctions day after day being imposed by Western countries, definitely affecting trade, while India is trying to find a middle path. Yes. Whether there is an imminent conflict possible at Taiwan or South China Sea. Again, sanctions, more sanctions, and disruption of supply chain. We have already seen the supply chains getting disrupted, right from non-availability of chips. Every industry in India has been affected. Now, the third, whether COVID-19 is definitely behind us or some more waves are expected. This again, fear of travel restrictions and flow of tourists, impact on hospitality industry, movement of goods, everything is a sword hanging. And whether international oil and energy prices will remain contained or will it flare up? Our dependence on imported oil and gas for driving our economic growth is substantial. We depend heavily on imported energy requirements. Now, the impact of the world global trade volume of goods and services, which is now projected to grow only at 4.1%. See, India, we have a dream of reaching the $5 trillion economy, which was thought about when all these positions were not there. Now, definitely, all these possibilities are in front of us, and we need a course correction. These are just a few of the examples. From these, can we still say that we need not bother about external environment? No, definitely no. We are concerned. The answer actually lies in preparing ourselves for any eventuality and riding the wave by building the various future scenarios. This is the idea of this webinar, and an expert and eminent person from the academic field, Professor Rudra Sensarma of IIM Kozhikode. Let me tell you, I have had the personal experience of the teaching and the encouragement and information given by IIM Kozhikode, including Professor Rudra Sensarma. We are in for substantial inputs. He is with us today to not only discuss, but also to guide the persons from the financial sector on how to be prepared for the future. In fact, The task before Mr. Sharma is to make the participants future ready. That participants include me also, Professor Sir. I am also eagerly waiting for inputs and guidance from you. I think I will hand over the session to you to carry forward. Thank you very much for inviting me and giving me this opportunity. Thank you.
Thank you, sir. May I now invite Professor Rudra Sensarma, Professor of Economics at IIM Kozhikode, to deliver the keynote address. Please listen closely because surely we are going to have many takeaways. We welcome you, sir.
Thank you very much. Thank you, everyone. Thank you, Rao sir, Ajayan sir, especially Kannan sir, whom I can call as my student because as he just revealed to you, he was in a class in IIM Kozhikode. So I have the privilege of referring to you as a student.
Yes, sir.
But very, very kind of you to mention that. And thank you, Rao sir and Ajayan ji, for the very generous introduction and invitation. So, Sunday evening with India-Pakistan cricket match going on, I have the challenge of holding your attention. So maybe to compete with the cricket match, I should start with a story. So I'll start by telling you a bedtime story, not to put you in bed, but to relate it with what is going on in the economy. Now, this is a story which I'm sure many of you have heard and maybe narrated to your children or to your grandchildren. So the story is of Goldilocks and the Three Bears. So let me quickly tell you the story and then come to why I am reminded of Goldilocks and the Three Bears. So the story goes as follows, that Goldilocks, is a little girl and she is walking in the forest and she finds a house and she walks into the house and she finds that there are three chairs in the house, one that is too big, one that is too small, and one in between the two. So she sits down in the medium-sized chair and then she is feeling hungry. So on the dinner table, she finds there are three bowls of porridge, one that is too hot, one that is too cold, and one that is just right. So she gulps down the porridge that is just right, sitting in the chair, which is medium size. Now she is feeling sleepy. So she goes into the bedroom and she finds there are three cots in the bedroom, three beds, one that is very big, one that is very small, and one that is in between. So she lies down in the bed that is in between and goes off to sleep. Anyway, so then what happens is the house actually belonged to three bears, one big sized, one small size, and one medium size. So they come back home and then the story proceeds from there. So what I'm referring to, friends, is often used to describe an economy as the Goldilocks economy. And why we say a Goldilocks economy is when an economy is neither doing too well nor doing too badly, but performing somewhere in between. So I find my diagnosis of the Indian economy as that of a Goldilocks economy, and let me tell you why so, and then I'll talk about the global economic environment. So if you look at Indian economy, our GDP growth rate last year was 8.7%, which was very good, but it also came on the back of a negative growth. So obviously there was this base effect which caused growth to go up last year, and also a recovery helped by the government's COVID time economic policies and the RBI's monetary stimulus. This year, when we are out of the COVID period extraordinary stimulus provided by the government or the RBI, this year we are still expected to clock 7.3% growth rate, as Kannan sir said, which will make us the fastest growing major economy in the world. Last quarter, that is Q4 of FY22, growth was a bit low, quite low, in fact, at 4%. But Q1 of FY23 is widely expected to clock 16%, and we will end the year at 7 to 7.5%. So I think this growth rate is not spectacular, but not low either. I think it is quite good given the circumstances and given the global situation that I'll describe in a moment. Particularly if you compare with global GDP growth rate, IMF has forecasted global GDP to grow at 3.6% this year, down from 6.1%. So if you look at it, global growth from 6.1 slowing down to 3.6, but India's growth rate still going pretty good at 7.3, marginally lower from plus 8% of last year, but still quite good. Just a couple of other numbers. If you look at inflation rate, it is high, no doubt. And that is something, which impacts all of us, including businesses and banks. There has been a third successive decline in July. In fact, inflation rate was at its highest in April this year at 7.8%. Since then, it came down to a little over 7, then a little below 7, and then 6.7% in July. Further expected to come down over the next few months as the RBI tightens its monetary policy through successive increases in the repo rate. So the inflation rate is not as high as in the US or in Europe, which is 9% or more. Neither is it 4%, which is RBI's target. So at 6.7%, it is probably somewhere in between. Very quickly, one more number, fiscal deficit of the government. It shot up to 9.3% of GDP during the COVID year and then came down to 6.7%. This year's estimate is 6.4%. This is the only number which is still a little high for comfort. Hopefully, the government may be able to bring it down further this year, especially if tax revenues are good. If you have been watching bond yields, I think bond markets are sensing that revenue growth will surpass expectations, because bond yields, Government of India bond yields have actually been falling in the last couple of months, even while the repo rate is going up. So I think bond markets are expecting the fiscal deficit to come down further. So yeah, fiscal deficit could have been higher. It should be lower, but we are somewhere in between. And I can go on and on. So we can look at forex reserves of the RBI, the exchange rate, etc. So we are in many aspects in a Goldilocks economy situation. Okay, now with that background, let me talk about the global economic environment a bit, and then I'll come to the implications for the Indian economy, implications for banks and other businesses. If I share my screen for a while, I want to show you a couple of graphs. So let me just pull up my slides and I'll continue to speak about the global economic environment and its implications for India using a few graphs that I have. So I already told you the story of Goldilocks, and let me start by looking at what is happening in Russia. Now, till last year, the big C, that is COVID, was all that we spoke about. But now we are no longer that concerned about the big C, COVID, but there are multiple C's that are dominating the global economic environment. So I'll talk about a few C's. So the first C is conflict. So that is the Russia-US war. Now, something interesting happened. It was widely expected that the Western sanctions are going to destroy the Russian economy, and Russia will be crippled economically and would be forced to end the war with Ukraine. That doesn't seem to be happening yet. The data you see on the screen is from The Economist magazine. So this is the rubles per dollar. So that is the exchange rate of the Russian currency vis-a-vis US dollar. So when the sanctions hit the Russian economy, that is in late February, early March, you can see that the ruble almost collapsed sharply. But since then, it has recovered. So the ruble is getting stronger and stronger since then, over April, May, June, and now it has kind of stabilized at 60 rubles to a dollar. So that took many people by surprise. How that happened is, of course, Russia managed to continue selling gas and selling oil, not only continuing to sell, but increased its sales to Europe, to India, to China, to African countries, to Middle East countries. And those revenues from oil and gas have helped Russia to continue to earn forex, which kept its exchange rate strong and stable. There was another interesting that happened, that the Putin may be very strong politically or in terms of international diplomacy or military, but I think he also delegates economic policy to experts, and the Russian central bank's president, I'm forgetting her name, but she's a very efficient and competent banker and economist. So she has been handling the monetary policy very competently. So she has increased interest rates sharply in the initial days of the sanctions, which helped to stabilize the ruble a little bit. And it also helped to control inflation in Russia. And since then, she has in fact cut the interest rates a little bit. So now inflation has stabilized in Russia, the ruble has stabilized. So Russia is not that badly affected as one had thought it would be. Of course, if the war continues for a longer time and the sanctions continue for a longer time, eventually it is going to hurt Russia, particularly as it runs out of imported components, machinery, electronic items. The sanctions might start biting. But as of now, it doesn't seem to be hurting Russia that badly. Of course, if you look at GDP growth rate and other data, there's a bit of uncertainty with the Russian data right now, so we don't know what to believe. But industrial growth rate seems to be quite normal in Russia, in spite of what is going on. In fact, their exports not only of gas and oil, but also food items, wheat, fertilizer, cooking oil, palm oil, these have increased. So that is what is happening in the conflict zone of Russia and Ukraine. Now, the second C, that is China. So in China, there are some concerns, mainly because of the slowdown in the real estate sector. So China's real estate sector has been doing very, very well in the past few decades. Extraordinary rise in home ownership. I think 80% of Chinese own a house. Property prices have been climbing very fast. The banks have been lending for property companies, real estate companies have been doing extraordinarily well. But that bubble, many say, seems to have burst, and now the real estate economy, which is almost 1/4 of China's GDP, is slowing down. It started with Evergrande crisis, and then other real estate companies also felt the heat. And China is suffering because of not only the slowdown in real estate sales, but because of the zero COVID policy that the country is following, because of which there are continuing stoppages in the economy, lockdowns continue, air travel continues to be hit. So that is a bit of a concern, that the second largest economy in the world is slowing down, which of course concerns all of us. So I'll come to the implications for India in a moment, but let me describe the world economy a little more. So this is the third C, commodities. So I spoke about conflict, I spoke about China, and then commodities. So commodity prices, which had shot up in February, March, and April because of the Ukraine-Russia war, seems to be cooling off now. So if you look at food commodities on the top right corner, wheat, corn, rice, palm oil, these have all cooled down since June, July, and August. So this is good news, particularly for commodity importers like India, because our import costs would be lower, our import bill would be lower, our forex outflow on account of imports is going to be lower because of the slowdown in commodity prices. If you look at crude oil prices, that's the graph at the bottom. Once again, crude oil prices had shot up to almost $125 in June, but since then it has been coming down, and it went below $100, and now it has settled at around $98 or $99, that is below $100. Of course, with crude oil prices, you never know, because there are multiple factors which influence crude oil prices. Demand and supply is one, demand based on growth from the buyers, the importers, and supply from the OPEC and also Russia. So those drive oil prices, but also over a longer period of time, you can imagine that if the world consumes less and less oil or fossil fuels over time because of a variety of factors, because of climate change concerns, emission control, if electric vehicles start replacing the internal combustion engine and we have more and more battery driven cars, the demand for oil could be coming down over the years. And perhaps supply is going to increase. Perhaps OPEC would be forced to increase supplies. The US shale industry is going to add to the global oil supply. There could be new discoveries. Countries like India also have oil reserves of more than 100 years, which we have not fully explored. So if the supply situation continues to be good, but demand falls, then in the long run, one would expect that oil prices would actually go down rather than go up. So oil prices coming down is good for India being an oil importer, and also other commodity prices are coming down. So it seems like the worst may be over as far as commodity prices are concerned. Now let me talk a little bit about the US economy, because this is the world's largest economy. And we have been hearing about stagflation in the US economy for a long time now. So here is a puzzle. The puzzle is that the US economy has clocked negative GDP growth rate for 2 successive quarters. And that is the classic definition or the technical definition of a recession, that is consecutive 2 quarters of negative GDP growth rate, as well as high inflation. And inflation had crossed 9% in June. So this extraordinarily high inflation rate along with negative GDP growth rate is what people described as stagflation, which is a very big worry for the rest of the world if the biggest economy is slowing down in terms of economic output while prices are rising. So that concerns all of us. Now, funnily enough, it is not very clear that the US is in recession or facing stagflation if you look at 2 data points. And I urge you to look at the first one, which is really a puzzle for which many experts are not able to provide answers. So the first graph is that of the unemployment rate in the US. So the first graph is unemployment rate. So if you look at unemployment rate, it is actually coming down. Unemployment rate has been coming down and is the latest data of July 2022. Unemployment is at 3.5%, which is the lowest, would you believe it, in 50 years in the US. So it is that good, hundreds of thousands of jobs are being created every week, and the US workers never had it better. So if the job creation is so good and workers are spoiled for choice, in fact, companies in the US are struggling to recruit workers. And there are worries that they have to pay higher wages, which might again fuel another round of inflation if wage growth picks up. Then why are we having this negative GDP growth rate in the US economy? So some people have tried to explain it by saying that this could be the unreliability of the GDP data to tell us about what is happening in the economy. There seems to be a disconnect between the GDP data in the US and other kinds of data. For example, personal final consumption expenditure growth has been high, which means people are able to spend more on consumption, which is aligned with this improvement in jobs. Income levels have gone up. Income levels of households have gone up. Corporate profits have gone up. Stock markets of the US seem to be sensing this, and there is a bull run going on right now in the US stock markets. So that is in terms of growth. So if you just ignore the negative GDP growth rate, in all other parameters, the US economy seems to be doing pretty well. And if you look at inflation, inflation seems to be now coming down. So the latest inflation number is lower from the previous one. So it seems like the US Fed's tightening is having an effect. So the quantitative tightening of the US Fed, that is rolling back the pandemic time easing, as well as the increase in the Fed fund rates, seem to be having an effect on inflation. So therefore, if it was a worry that US stagflation or US stagnation is going to hurt emerging markets, including India, it may still happen, but it may not be that bad. So what seems to be likely is the US may be going for a soft landing. So they are probably going to get bruised a little bit because of a combination of global shocks of Russia as well as China, as well as domestic policy-driven inflation. As you know, during the COVID period, the US had spent more than $1 trillion on COVID recovery package, which seems to be manifesting itself in terms of inflation now. But the Fed tightening of US policy seems to be helping inflation without hurting job growth. That is also probably because of the inherent competitiveness of the US economy and the agility of the labor market that they are able to pull this off. There are some concerns now. You may have read about the student loan waiver. So Biden seems to be waiving of student loans worth $500 billion, and that bill has to be footed by the government. So the downward trajectory in inflation, which started in July, may get reversed if the US government goes ahead and waives off this $500 billion of student loans. But then if the Fed is able to continue to increase interest rates, it might still be able to manage to bring inflation down and keep jobs going. Now, I described to you, a few of the major economies in the world and what is happening in these countries. Now, why does it affect us? So, as Kannan sir said, why should be concerned about what is happening in the rest of the world? Let me take a quick opportunity and take a cue from that comment of why should we be concerned with what is happening in the rest of the world, and show you something called the balance of payments. So this is balance of payments of Indian economy, and it shows you the different ways in which India is connected to the rest of the world. So just scanning through the balance of payments tells you what are the different ways in which India is connected with the rest of the world. So when there is a crisis or volatility in the rest of the world, it affects us through these various items. So on top of the balance of payments, you will find a merchandise trade, that is exports and imports, and you will find invisible trade. So invisible trade is services. So if the rest of the world is slowing down, it is going to hurt our merchandise exports. So that's the first hit. If oil prices go up, it is going to cause import bill to go up, and the weakening of the rupee vis-a-vis the dollar is going to make imports costlier. So that would reduce imports. So that's how it would affect what is called the current account. So that is the trade part. And then if you scroll down the balance of payments, you will find the capital account, where you find foreign investments into India and out of India. So both the credit and debit items are there. So foreign investment constitutes the foreign direct investment, as well as portfolio investment. Portfolio investment has an equity component and debt component, and I'm going to talk about that in a moment, which is why I'm just showing you this. So I'm going to talk about what has happened in the recent period on some of these items. The capital account also includes loans, which is external commercial borrowings and other short-term credit, banking capital, rupee debt service. So rupee debt service is something from the past. Some of you may know that this was an arrangement with the former USSR, which is a loan that we are repaying through some arrangements to the various constituent countries of the USSR. And then if you add all of that, that is the overall balance. So if you look at the overall balance, then compared to the last quarter, it seems that the overall balance has gone up. So the overall balance is 47,501 compared to negative 16,024. This is in million US dollars. So the overall balance of payments position in in April to March 21-22 seems to be better compared to what has happened in the previous years. So that is, these are the different ways through which rest of the world is going to affect the Indian economy. Now, coming back to how it has affected the exchange rate. So I'm just drawing upon an article I recently wrote on the Money Control website. So I'm just showing you the graph from that. So this is an interesting finding. So I looked at the exchange rate behavior, and all of us know, we have heard that the rupee has depreciated. The rupee has depreciated by 6 or 7% since January this year. Now that's the depreciation. If you see from about 74.5 in January, the rupee went up to 79, stopped short of 80. It seems that 80 is some kind of a psychological mark, and the RBI is not allowing the rupee to cross 80, but the rupee is pushing the door, trying to breach 80, but there is protection being given by the RBI, which I do not really agree with, but that's another matter. But more importantly, if you look at the red graph, so the red line is volatility. So what I have done is I calculated the standard deviation of the exchange rate. So this is a monthly average of daily volatility in the rupee. And you see that the volatility of the rupee has come down. So something started happening from May onwards, and the fluctuations in the exchange rate have come down. Which means that even though the rupee is weakening against the US dollar, which all of us know, but the pace at which that is happening has slowed down. And there are a few reasons, and let me explain to you what the reasons are. So one, of course, the measures taken by the RBI on July 6th, which were multiple measures, including liberalizing some of the ECB norms, giving relief on NRI deposits by way of allowing interest rates to be higher and exemption from CRR, SLR calculations, liberalizing foreign portfolio investment in Indian bonds. So those seem to have helped to stabilize the rupee. And the RBI has also been using its forex reserve. So RBI has been selling dollars from its forex reserves to meet the dollar shortage caused by the outflow of dollars, which has meant that the RBI has done or RBI has performed its primary function of smoothening the volatility in the forex market. If you remember, that's what RBI's job is. RBI's job is not to manage the currency value, but to manage its volatility. So RBI only intervenes in the forex market to ensure orderly conditions in the exchange rate. So that is what seems to be going on. So the secular movement in the rupee seems to be that of a weakening trend vis-a-vis US dollar, but the rate at which that is happening is coming down. Now, that is, of course, vis-a-vis the US dollar. If you look at rupee's performance versus other currencies, it is actually not that bad. So if you compare, let's say, if you look at the nominal effective exchange rate, for example, which is India's rupee value vis-a-vis a basket of currencies, that is currencies of our major trading partners, the nominal effective exchange rate has hardly moved since January of this year, which means rupee has neither strengthened nor weakened vis-a-vis our trading partners. So then why has the rupee depreciated against the US dollar? Because the dollar has become stronger. So it's the dollar that has strengthened, making the exchange rate with rupee look the way it is. And the dollar has become stronger because investors are buying dollars. Investors are moving into dollar assets because of the panic or because of the uncertainty, which ironically is caused by the negative GDP growth rate in the US. So the negative GDP growth rate in the US actually benefits the US dollar, because the US dollar and US assets are safe haven investment destinations. So this dollar buying is causing the dollar to become stronger. The dollar index is going up, whereas the rupee, not only the rupee, but other currencies. But again, when I say that India is a Goldilocks economy, if you look at other currencies, there are some currencies who have performed worse than the Indian rupee. So if you look at Turkish lira, for example, Turkish lira is depreciated by, I think, some 40% against the US dollar. South African rand, even the euro has depreciated by 7 or 8% against the US dollar. South Korean won, they have all depreciated against the US dollar. But then there are other currencies which have held up, like the Japanese yen, the ruble, as we saw earlier. So the rupee has neither done too badly nor done very well against the US dollar, thanks to the slew of measures introduced by the RBI. And also, if you look at foreign investments, Mr. Kannan mentioned that there has been an outflow of investments. Actually, if you look at portfolio investments have been coming back. So a turnaround happened. Something happened around June. I think the sentiments changed, probably because of RBI's handling of the economy, the repo rate hikes. Portfolio investments are now net positive. So even if you look at the latest data for August, the data is available up till 26th August. There has been, I'm forgetting the exact number, something like $12 billion of portfolio investments happening into India. And why suddenly we have positive portfolio investments happening? So partly it is because the portfolio investments are driven by equity right now rather than debt. I'm sorry, it's not $12 billion, $7 billion in the month of August till 26th August. So how come $7 billion positive net flows are happening in Indian economy in a month? Because this is equity. So debt, there is still a problem, because when the US Fed is tightening interest rates, the interest rate differential with India narrows. So when the interest rate differential narrows, then debt investments would experience outflow in search for yields in the US. But equity, there is still interest, and therefore this $7 billion out of this $6.5 billion is just equity. And that seems to be a vote of confidence by foreign investors in Indian economy's future prospects. So the foreign direct investments anyway are, have been clocking $5 billion every month for the last 1 year. So with FDI, there has never been a worry, because FDI anyway looks at long-term prospects in the economy rather than short-term factors. But even portfolio investments are looking very good. So that gives some hope that the economy looks to be on a strong momentum. And if you look at even your industry, so bank trade growth, you would have seen, has been phenomenal. In the last data was 14%, which is the highest in several quarters. So this means that credit is there, foreign investments are coming in, expenditure is happening, the growth momentum is unstoppable. In fact, there are some concerns that there could be a liquidity issue with banks, and banks are now competing to collect deposits by offering good terms because of the tremendous credit growth that is happening. So overall, I would like to stop in a minute. So overall, I would say that while the global economy is still not out of the woods yet, but the US economy gives hope that the stagflation may not be as bad as many people are saying, as I showed you the data. And if the US economy holds up, Russia and a few other countries are anyway unaffected. China seems to be the only problem, but if China is a problem, that's also an opportunity for India, because it means that many of the investments that would have gone to China are going to come here. In fact, that's already happening. So as you would have seen that some of the semiconductor companies are now interested in India because of the lockdowns in China. Tesla is majorly affected by the recent lockdown in China. There are power outages happening, and they are also considering investment in India. So I think China's slowdown could be an opportunity for India, and the US economy going strong could mean that we may not be that affected. Of course, the growth may be slower than was possible than was thought possible before the Ukraine war started, but growth will still happen. And if the Ukraine crisis gets over sooner than later, then of course the dark clouds would go away from the global economic horizon, and then we could expect very fast growth rates in the next few years. In fact, we need to grow at very fast growth rates, because if you look at per capita income, we are still a very poor country. Our per capita income levels of $2,000 is 1/5 of many of the emerging countries like Brazil, China, Russia, South Africa, whose per capita incomes are at $10,000. We are at $2,000. So we need to grow much faster. Our fundamentals are still strong. We still have the demographic dividend going with us. Whether we are leveraging it or not is another matter, but the demographic dividend is still with us. Our economic diversity is still with us. RBI's forex reserves are very strong. The external debt to GDP ratio of the Indian economy is actually coming down. So even though forex reserves have come down in the last few months, because obviously the RBI took a bit of hit, if not a bloody nose, in trying to protect the rupee, the forex reserves came down to $570 or $60 billion now, which is lower than $633 billion of last year. But still, it gives us an import cover of almost 1 year, which is very drastically different from Sri Lanka or Pakistan or Bangladesh. So those comparisons, as Raghuram Rajan has recently pointed out, are rather silly because our forex reserves are far stronger than many other countries. So with that, I'll end here. Probably I'll just show you my last slide, which was an interesting quote from Shaktikanta Das, RBI governor, in 2020 policy, which I really liked, and I think that is something we should all keep in mind. So the governor said, in the face of adversity, we have a choice. We can be bitter or we can be better. So I think, as I said, crisis is also an opportunity, and we are going to get better from here on. There is no doubt in my mind. Thank you very much. I look forward to your questions and your views as well.
Thank you, sir. We now open the session for interaction, moderated by Ajay, sir.
Wonderful session as always. I would like to travel miles together to hear you speak. If I understand anything of economics only, I understand when you talk. So simple as that. So it's so nice taking us through Goldilocks and the 3 C's and the one world of the American economy and the dollar and what's happening around. So very pertinent points that you put forward. And very essential for especially senior bankers to understand and to get an overview of what's happening around. So now we'll take few questions. If some you can unmute and ask Professor Ji any of your clarifications, or if you want to present any points. Open now, please.
Professor Sharma, I am Rao. I have a small question to you, maybe look silly for you, but then yet, as Ajay said, many things we may not be able to digest what you said, but I just want to ask you, why Sri Lanka is struggling? And what is the problem in Sri Lanka? Why it is struggling, and is it having any impact on India also?
Okay, thank you, Rao sir. Let me answer your question, and there is another question, Ajay sir, in the chat window, which I'll also answer. So, so starting from Sri Lanka, well, as you know, there are multiple factors and not just one. So the usual reasons being the loss of tourism revenues, starting from the terrorist attacks to the COVID period, loss of remittance flows, and also bad domestic policies in terms of huge populist spending by the Rajapakshas. Then there are these issues of import bans, fertilizer bans, which caused crisis in the agriculture economy, etc. So there were multiple reasons. But why I said it's not comparable with India is because if you look at the central bank's role, So the Central Bank of Sri Lanka's forex reserves came down to $500 million. That is less, half of $1 trillion, half of $1 trillion, when their external debt was $5 trillion. So external debt is 5 trillion, not just external debt. In fact, the debt outflow expected in this year was 5 trillion, but the central bank had less than $500 million forex reserves. So obviously they had no option but to declare that they are going to default on all external obligations, and they were not in a position to even buy oil, buy food and other critical imports, which is where countries like India helped them out. So I think it's a combination of bad policies and also poor central bank performance, because the government may do what the government wants, which is to use fiscal policy or populist policies for political economy reasons. But when it comes to independent institutions like the regulatory institutions, you expect them to, which is why I made a mention of Russia's central bank. And thank you, Sabari ji, for pointing out the name of the central bank president, Elvira unpronounceable Nabiulina. Okay. So, but if you contrast with another country, Turkey. So in Turkey, the central bank is under the capture of the ruling government. So no wonder that the Turkish lira is collapsing and inflation is sky high. The 80% inflation in July. The central bank is under direct capture of the political authority. So I think that is where Sri Lanka has failed, other than the failures in policy. And that is where I think India, because of our strong regulatory institutions, are better off than Sri Lanka.
Thank you. Thank you. Why do you want?
I am Rajkumar.
Okay, I'll take, yes, sir. I'll take your question and then answer Mr. Rao's depreciation question. Go ahead, Mr. Rajkumar.
I am Rajkumar, retired General Manager, PNB. In your speech, you have well explained the various aspects. One aspect, more or less, you are giving a picture that India may not be that much affected because of certain factors, except the China factor. There also you have found some positiveness, saying that we have got an opportunity also. But India, balance of payments, when you have described, you have said that we are having connections with most of the countries by way of export or import. India is exporting to so many countries. In all these countries, if they are affected, though we are not directly affected, if they are having internal problems on account of COVID or whatever reasons, will it not lead to default in payment of exports, and it can affect us in a direct manner? This is my question.
Yeah, thank you for the question. You are absolutely right. Of course, if the world is in a problem, then we won't be insulated from that. But if you look at India's top 5 trading partners, the top 5 trading partners are, I don't remember the order, but essentially US, China, UAE, Saudi Arabia, and surprise, Switzerland. So these are India's top 5 trade partners. So among them, the Middle East countries seem to be rather unaffected. So, our trade relations with UAE, Saudi Arabia, and other Middle East countries continue. US, as I said, I'm optimistic about the US. So that would not affect us so much. With China, anyway, we have a trade deficit. So we are not exporting much to China. So in terms of export prospects, that doesn't hurt. Of course, we do export things like steel and a few other pharma and other products to China. So that, of course, may be hurt. So I agree with you that if our trade partners are going to be affected, that is going to hurt our exports. So therefore, we should not be complacent. So my speech is not a call for complacency, but to seize the moment, so to say, which is we need to actually double down on policies to improve ease of doing business, to improve foreign investments, to improve exports, so that not because of the global economy, but in spite of the global economic situation, we are able to do better. So yes, I mean, the growth will not be as much as was thought perhaps in January this year. So compared to January this year, the prospects are down because of the reasons you mentioned. but still because our major trading partners are less affected, I think the headwinds will not be that strong.
I think ECGC will be working very hard now, because there will be so many, in case of this kind of defaults, ECGC can have some problems because so much claims will be on them and they will have to meet the claims also.
Yeah, I agree with you. So that, ECGC will no longer be an E, but CGC. So it may continue. But that is not something, we talk about it for India. But if you look at the US, the biggest economy in the world, has the biggest credit guarantee schemes in the world. So they backstop all sorts of loans. The government backstops loans to the students, loans to housing sector, loans to businesses. So that is a global policy approach to use credit guarantee to support credit. So government of India, of course, increased that because of the COVID period, but that may continue. You are right. I mean, defaults may happen.
Okay, thank you. Can you answer the question?
Yes, yes. So on exchange rates, so should exchange rate be higher or should it be lower? There is no good answer to that. Unfortunately, we have politicized the exchange rate in the country that it has become a matter of political debate. But really, as you all know, that we gain and lose both ways. So there are winners and losers either way. So when the exchange rate goes up, that is rupee weakens, obviously exporters will benefit. In fact, FDI will probably come in more because when the rupee is weaker, foreign investors can buy Indian assets at a cheaper price, at distressed prices. So FDI may actually be encouraged by a weaker rupee and exports will also grow. On the other hand, if the exchange rate goes down, that is the rupee is stronger. So it's going to be good for imports. It's also going to be good for inflation because the imported inflation will be low. I think that is the reason why we do not control the exchange rate, which is a very smart decision because it's not clear whether high or low is going to be good for us. So therefore, the RBI also has taken the position that therefore we will not manage the exchange rate. Let it reach its own value since it's not clear what is the ideal value which is good for the economy. Just that we know from a political economy sense, a weaker rupee has more backers than a stronger rupee. A weaker rupee helps exporters and it creates jobs. So there is often a policy bias towards a weaker rupee. That's my personal opinion. Whereas a stronger rupee helps consumers who are not really a united entity. So there is no voice for a stronger rupee, but lots of voices for weaker rupee, and policy bias has been towards weaker rupee for a long time, which is good for exports and job growth.
FDI may be attracting a weaker rupee.
Yeah.
But once they want to get back the money, if this trend is showing, then they will be concerned.
I agree with you. So they have to balance the exchange rate losses with the returns that they or the profits that they earn in the host country.
Okay, thank you. If we take one or two questions if possible, maximum one. Yeah.
Just a small one, Mr. Sharma. Apart from I'm Kannan here. Apart from whatever factors you have mentioned regarding the exchange rate, a few more things. Like you said, depreciating rupee is always welcome with many because that is exporters lobby is always strong in India. Okay, and there is no importers lobby. Okay, like that. Importers lobby is only the consumer like you and me who get affected. It's an imported inflation. Okay, number one. The second point, our main imported one is oil and energy. Okay,
yes. Which
of course is taken care by the government. I mean, bilateral and all those things. The other items, yes, they do get affected, but that will encourage more people to go into production or manufacture in India, which indirectly supports Atmanirbhar Bharat. Okay, this is also a factor. I thought I may mention it over here.
Yeah, I agree with you, Kannan sir, that this may also encourage domestic production. But I would also hasten to add that domestic production improvement should come from improvement in the business environment and inherent competitiveness of the economy and not with the exchange rate. If it happens with the exchange rate, yes, it could be an additional bonus. But I worry if the policymakers start looking at exchange rate as industrial policy.
No, I just mentioned that it will act as a catalyst.
Catalyst, yes,
Yeah.
yes.
Thank you, Bharati ma'am. You have any point to make, or shall we? Yes.
We can close down,
Yeah.
JNG.
Thank you very much. Okay.
In fact, wonderful session, Professor Rudra Sensarma. In
Thank
fact,
you.
an eye-opener.
Why wonderful session, no doubt about that.
Wonderful, wonderful.
Thank
We
you very
look
much.
forward to many more sessions.
Yeah.
Thank you.
Princey, you can.
Yes, sir.
Prince-
Thank you, everybody. May I now request Lalita ma'am to propose the vote of thanks. Lalita ma'am.
Yes, Princey. So it's been a very, very, enthusing evening with very wonderful talks that we've been listening to. At the outset, let me thank Mr. Kannan, who graciously agreed to come and spend this evening with us. He actually set the stage or a launch pad for deliberating on a very pertinent topic of the day, taking stock of the hows and whys of present-day economy under these very special circumstances, which is common to the entire world. And with him, just to sort of supplement the anxieties that are in our minds, we listened to a very brilliant presentation by Professor Rudra Sensarma. He started off so interestingly with the Goldilocks allegory and went on to review the world economies and its implications for India. Very, very insightful observations, substantiated so well with appropriate data. He also, gave us a very interesting study of the rupee and its roller coaster ride with all the other currencies of the world. I believe he ended on a positive note, saying that there is hope for the world and for India as well, and things are going to be bitter. I'm sorry, things are not going to be bitter, but certainly better for India and the world. Thank you very much, Professor, for that very insightful lecture. Thank you also to Mr. KLSN Rao for presenting the topic, to the participants who took part in a very lively discussion, generating more and more interesting insights into the topic of the day. Now, let's all sit back and look forward to all the other participants, I'm sorry, who were quiet listeners, but who added vigor to the entire session today. Thank you, everyone. And let's all look forward to the next lecture in the series, probably in the next month. So thank you very much, Chief Guest. Thank you, Keynote Speaker, and to all else who were here with us this evening. Thank you and good night.
Thank you. Thank you very much. Good night.
Good night. Thank you very much, sir. Thank you very much. Good night. We will be sharing this recording in a couple of days, sir. It was also live on the YouTube, but 5 or 10, as you said, cricket today.
And also, Ajay, that I would also intend to put it on our website, college website, series, so that it will lead to larger participants across banking, which is very useful.
We shall share the video, sir.
Now, finally, my question to Professor Rudra Sensarma is that what happened to that Goldilocks ultimately? It went in between.